We have three treasury bonds that have been reopened for the September 2025 auction, and in case you are considering investing in this auction, you might be in a dilemma of trying to decide which is the best bond for you, trying to figure out which bond should you go for. Is there an ultimate bond among the three that is better than all the others? That is the dilemma that we are going to deal with in this particular video by trying to discuss some of the factors that you should consider when choosing a bond to invest in. By the end of this video, you ought to have decided which bond you are going for in case you are participating in this particular auction. Welcome to Finance Focus with Andrew, a platform where we engage in conversation that endeavor to enhance our financial literacy. In case you are coming across this channel for the first time, subscribe, turn on the notification bell so that you get notified anytime we post a new financial tip. Now, let's dive in. Now, we have a few factors that you should consider when choosing a bond to invest in, and we'll discuss the factors and customize them given using the example for the September 2025 Treasury bonds deals. Now, number one factor that you ought to consider, we are all human, and the better the return, the more the return, the better. So number one factor that you should consider is the coupon rate. And I know this is what majority of people get to consider, but I would like you to understand that there is more than coupon rate when it comes to choosing a bond to invest in. Now, the coupon rate is the interest rate. It is the return that you take home. I know you want a better return, but some other factors might make you not choose the best, the bond with the best return. Now, let's consider this September 2025 auction. We have this first bond giving a coupon of 13.2%, 14.188%, and 12.0%. Of course, if coupon was the only thing that we are checking on, all of us would go for this particular bond, FXD1/2022/2025, that is giving us a coupon of 14.188%. That is the bond that we could have bidded on. But is that the best bond for everyone? Let's move on. Time to maturity. It is a very, very, very important aspect to consider. Time to maturity tells you for how long will I tie this principle that I'm getting to invest. When will I get back my money? So let's see. For the first bond, you'll get your money back after 12 and a half years. For the second bond that had the highest interest rate, you'll get back your money after 22.2 years. And for the other bond, you will get back your money after 15 and a half years. You see? Now, make a decision between the three. Now, you might have chosen the first, this bond when you talk about coupon rate, but again, you realize you are not ready to tie up your money for the next 22 and a half years. And you want, maybe you can consider 12 years, but 22, it's a lot. So you are probably going to go for the first bond, even if it is giving a coupon of 13.2%, simply because it have a less maturity time. Let's go to the other factor. The other factor is the tax factor. For this particular auction, there is no choice based on this particular factor, because the three bonds are giving a coupon of 10%. No, they are subject to withholding tax of 10% for each and every bond. So there is nothing to consider there. Now, let's consider about liquidity. Liquidity is how fast can you be able to convert your bond back into cash, and this can be done in two ways: selling it in the secondary market or rediscounting through the Central Bank of Kenya, which might come at a cost. But before we even consider the cost, what is that? How easy is it to convert a bond that is 12 and a half years? Now, I can assure you that the longer the maturity, the harder it is for you to liquidate that particular bond, because majority of not many people might be interested in buying papers that have a longer period of time. So the bond that have the highest coupon might be the hardest to liquidate. So again, you might come back to the bond that is quite more easier to liquidate because it has a shorter period of time. Hence, it might be easier to liquidate. You can also consider pricing, but this can only be considered when you are buying bonds from the secondary market, because you can be able to tell the price of a particular bond. For this particular auction, we can only know the exact price after the auction is done. So when bidding, you cannot be able to take the advantage of the different bonds prices. But when you are buying from the secondary market, you can actually consider the price of the bonds. Now, going back to this auction, I only see two determining factors that you might have to choose between. Number one is coupon. If your mind is purely on the return that you are getting, without considering anything else, without considering time, without considering what, you go for the FXD1/2022/025 that is giving a coupon of 14.188%. The other thing that is a key determinant that you might use is time. For how long are you willing to have your principal amount fixed? If you are okay with a long time, go for the bond that is giving a higher coupon. But if you are just okay with some short time, you have no option but to go for the 12.5 years bond. So those are some of the factors that you can consider when making a decision between the bonds, and ensure that you get the full information about the particular bond so that you don't sign up for something that you don't understand. In case you have further questions about treasury bonds or this particular auction, drop them in the comment section and be sure that will be addressed. Until next time, stay financially woke.